Welcome everyone to the 9th Annual ASC and Healthcare Management Symposium hosted by Garfunkel Wild. Today, I have the pleasure of presenting the current state of healthcare transactions with my esteemed colleagues, Bob Goettling and Matt Searles. I am Kimberly Kempton-Serra, a partner at Garfunkel Wild. My practice focuses on corporate transactions with various types of healthcare providers. And I have a focus on ambulatory surgery centers. Matt, why don't you tell us a little bit about yourself now?
Sure. I'm one of the partners with Merritt Healthcare Advisors. We're an investment bank that focuses on merger and acquisition capital raises for, what are called lower middle market healthcare transactions. So we do focus solely on healthcare services. So these are large practices, facilities, urgent care companies, things of that nature. But we are pretty specialized in that regard, and we are really just trying to focus on those types of transactions. And looking forward to chatting today.
I'll go next. I guess me next. Bob Goettling with the Bloom organization. I've been in what I call the doctor business for the past 30 years. Back in the 90s, was one of the founders of one of the first practice management companies and ran the development side, buying physician practices, surgery centers, all that. Then spent the last 15 years on the other side with the Bloom organization. And we are with Matt, we're a boutique investment bank focusing on physician services. I oversee all of our transaction services. We primarily are representing the physicians on the physician side, but as of the last couple of years have gotten into much more of the more complicated and complex multi-party market consolidation transactions.
Thank you both for introducing yourself. I will just give a brief overview of today's presentation. First, you'll hear about the current state of the economy and how it's affecting healthcare transactions, if at all. You will hear about the more attractive specialties that buyers are currently interested in. You will have an overview of matters that all parties to a transaction should consider. You will also learn about trends in market consolidations, as well as the new corporate players in healthcare and how they are affecting the industry. Matt, why don't you start us off by going over the state of the economy?
Sure, no problem. Clearly after a 12+ year expansion period in the economy, strong stock market, historically low rates, we're at the point where we're seeing a lot of those trends reverse. I think we're probably likely heading into a recessionary period. Interest rates are considerably higher, although still historically relatively, lower. And that's going to have some level of impact on what's happening in healthcare. I would say that, through the last couple of recessions, which I can remember, there's not a real correlation between the general economy and healthcare. It tends to be defensive. It tends to, continue to be, a busy space, even in economic downturns. That said, I think we all are certainly, coming off some of the higher valuation periods we've seen in our careers. And I think it's likely that erodes somewhat as the cost of capital goes up. So I think that, the interest level is still very high for sure, but we're going to start to see some impacts, in the near term on pricing. And although I am optimistic that it won't necessarily impact the number of interested parties that we're used to dealing with, more on the valuation side.
Bob, why do you think buyers are still interested, and who are they? And why is there still a hot market given all of the downsides that Matt just discussed about the economy?
Yeah. The first thing I'll say, Kim, is that I gave up long ago trying to predict the future, because that it seems that I'm always wrong on that. So why I can't I can't give you a cogent answer as to the why, but I can tell you, at least at our firm, we have over 25 ongoing transactions. We haven't had one yet, knock on wood, where they have changed a valuation based on, the higher interest rates, even though, most of the transactions have some element of private equity involved in them, and private equity are, by definition, leveraged deals where they're borrowing money, but haven't seen it yet. And so, to Matt's point, I agree. I think it's gonna have to show its face somewhere. But I do believe with with all the consolidation and all the changes in healthcare, it probably won't be in the interested parties or the numbers of transactions. It just may, to Matt's point, we have had, record value and valuations, and for that to, it would seem that with interest rates going up, for that to at some point start trending down a little bit, would seem to be common sense. Now, I will say of the buyers, and we have a slide later on where we'll talk about some of the new buyers, all of the what I would call the usual suspects in physician deals. They're all still there. Health systems, again, and not only just there, getting more aggressive. Health systems are getting more sophisticated and aggressive, so they're still the buyers. Obviously, you've got the private equity platforms and the private equity firms that with their and doing their platform transactions and then their add-ons. And then you also have the strategics, which encompasses the payers and, a whole lot of others. So we see still, tremendous interest and increasing interest from all three of those sectors, or all three of those buyers. As far as specialties, with the exception of pain management, that just seems to have really been hammered the last couple of years from a transactions perspective, not from operational or value creation, but just from a transaction perspective. While that's been hit, most of the other ones that we deal with are still very vibrant. And as far as some of the new ones coming out, we'll talk, I know, about cardiology, which is definitely a hot one. And we're also seeing a huge focus on value-based care companies, a lot of different kind, that's a big bucket to fit in, all the different companies that are focused on trying to reduce the cost of care. And then as a third one, I'll note home health also seems to be, very hot now.
Okay, thanks. I'm going to go back up to the top, the valuation issue, and I'll ask Matt if you could just kind of give a brief overview of how typically a seller practice is valued, and what these numbers mean and what affects them, I guess.
Yeah, so there's a lot of numbers on that slide that you kind of, accurately walk you through the mechanics in that example. But if you think of it, at a higher level, just 30,000 feet, there is tremendous interest in value in consolidating physician practices. We're seeing that it bends the cost curve in the right direction and creates a lot of value. So, money's coming in and trying to, execute on that consolidation. And the way that they're structuring it essentially is, coming in and paying reasonably high multiples. This example uses 10 to 12x. They can be higher. And they're designed so that the physicians on an ongoing basis, the partners on an ongoing basis, are still very much incented to keep working hard. So what you'll see is not all of the practices purchase. It's going to be essentially a minority interest. Some level of income that's purchased. Let's call it, in this example, around 30%. And the payment for that is going to come both in the form of cash and equity in the ongoing business. We call it the management service organization that comes in and is the umbrella for a lot of these practices. So what you'll see here is making sure that the physicians are still very much incented from a current income perspective. Obviously the multiples are very high, but then even the payments the payment that is made for what they are selling is done in the form of cash and equity, so that there's these continued incentives for folks to continue to push, because we know from experience that deals that purchased more than, that purchased entire practices with cash. The FICORs of the 90s, models just didn't work. So these are kind of specifically designed to align interests. And that's what this value illustration shows.
Okay, thank you.
Mhm.
Bob, I know you said you try not to predict the future, but if you had to pick one or two economic indicators that are helpful to foresee a change in the healthcare industry, what would you say are most important? Is it interest rates? Is it tax laws? Is it, managed care rates? Or is there something that when you see it, change is coming?
Well, I'll take I'll just take the easy one, because some of those other economic variables can be very difficult to figure out what the impact's going to be. One thing I will say in this business, going back to delivery of care and the whole value-based care industry, I call it a bucket of companies here, but it's really a whole industry, all with the focus of maintaining quality, but bending down the cost curve. And I think that fact of focused on bending down or reducing the cost, the out of control cost of the healthcare system here it will continue to be a driver. And I think it then ends up creating different companies, different delivery mechanisms, a whole myriad of changes in the delivery system, all based on how can you keep the quality and at the same time reduce the cost.
Okay, I'm going to move ahead to you alluded to this earlier, to cardiology.
Yeah, I mean, certainly cardiology is a space, right, Bob, that bankers like Bob and I have not really had a lot of clients in the past because they didn't exist. In most recent years, we have an increase in the frequency of these types of engagements, because there is now a mechanism for cardiologists to move out of the hospital arena and into ASC OBL models that really, again, kind of bend that cost curve in the right direction and provide that entrepreneurial environment. And Bob, I know you have some thoughts on that as well.
Yeah, in fact, Matt and I, one thing we have in common is we like the specialties that the market is attributing the highest value to, and cardiology happens to be one of them. How long it'll last, I don't know. I agree with all the stuff Matt said as to the drivers as to why. But the thing that interesting to me, who's seen this, so many times, the pendulum swinging back and forth from the physician side. What interests me about cardiology this time is the fact that when you look at a lot of the other specialties that have led the last 20 years of quote coming out of the hospital, cardiology is one that really can't. It needs to still have a very direct relationship with the hospital. It's not like ophthalmology. It's not even like orthopedics, as the joints and spine and everything come out of the hospital to the ASCs. It still has a strong connection with the hospital. So I think what it's showing, I mean, there's tremendous amount of value, as Matt just said, as it starts to come out more and more from the hospital. There's opportunities for the cardiologists and the cardiology groups and the cardiology ancillary services companies. But I really do believe there's going to be some very, interesting bedfellow deals done in the cardiology space that will include more than just private equity in the cardiologist, hospital and a cardiologist, payer and the cardiologist. I think you're going to see some interesting consolidations in particular markets that are going to really create some value in the space. And again, the physicians will always be leading that. So, they'll be, front and center at the table, I believe.
Matt, do you think, I mean, when I think of cardiology, I also think of vascular and the topic of the office-based labs, and how viable do you see those types of centers, I guess, popping up in the future, are they appropriate for outpatient? Are they and are they lucrative to be done in an outpatient, standalone facility or office?
Yeah, I think that and it doesn't always happen in practice, but I think generally if you look at cases being done in the most appropriate environment, that means, can it be done in an OBL safely and at a low cost, lower than a surgery center or a hospital? And the answer for a lot of vascular cases is yes, they absolutely can. I mean, vascular surgeons do the most complex hospital cases on one end, and they do these very, very simple cases, the higher volume cases on another. And so it's a lot like, pain management in that regard. They can be done safely in that environment. Many fewer cardiology cases apply there. They're just coming out of the hospitals and into surgery centers where they still need that, sterile, more careful, regulated environment. But sure, I mean, I just think it depends what you're doing in the OBL, and it certainly has, from our point of view, will be sustainable if folks are focused on, quality of care and delivering that care and, the lowest cost setting. That's going to be something that we, see kind of perpetuate.
Okay, thank you. Bob, you'd mentioned value-based care, and we talked about cardiology. What is making home health and potentially primary care sort of hot assets for buyers currently? I have to assume part of the home health is just the aging population and the desire to keep patients at home. But what is making them so valuable that they've gotten buyers' attention?
Yeah, I think that's spot on home health. I think it's exactly that. The aging of the population, and if you look at the experience through the whole COVID thing, where people didn't want to go in to so I think that kind of drove it too. And again, there's probably other more sophisticated dynamics driving home health, but it is a specialty now that's getting an awful lot of attention from all of those that I mentioned earlier, the usual suspects from an acquisition perspective. Primary care, I guess actually, at least the way from the way we look at it at Bloom and with our clients here, primary care is part of value-based care, because the primary care opportunities now that are, just crazy. I mean, in most states, if you're a primary care physician, you're probably getting, 4, 5, 6 calls a week. Because everyone is after, especially the Medicare Advantage lives, and that all goes back to the value-based care. Which again, as I said earlier, the whole focus there is trying to maintain the high quality and level of care, but bend the cost curve down. And there, by figuring out in specific ways how to do that, there's a tremendous amount of value created. Hence the popularity from from an acquisition perspective.
Thank you. I think we will move on to transaction considerations and what each party to a transaction should take into account when deciding whether or not to engage in a transaction. I'll ask Matt to just kind of walk us through some of the benefits to doing a transaction from, I guess, the seller side, or we'll call it the physician side.
Sure. Clearly, there's a strong financial incentive that's in place. We do know that valuations are high. There is, considerable cash payments today. There are rollover equity. There are tax benefits to these transactions in terms of monetizing future income at a lower tax rate. So there's these clear financial benefits to just execute a transaction today. But what we tell folks is listen, focus on the post-transaction benefits. It's great to be able to monetize the practice in a way that has not been really possible until the last let's say 5 to 10 years. Physicians will retire and keep their receivables, and that would be it. But here we have an opportunity, in a really robust evaluation environment. But we want folks to pick the right partners and make sure that all the things that are pushing them towards a transaction meaning the difficulty in running smaller, fragmented practices, as we even a practice with 50 physicians we'd consider small and fragmented, towards an ecosystem that has more scale and is able to really mitigate the challenges in running these practices, which are continually seeing reduced margins on a year-to-year basis, and inability to contract with payers, and in terms of getting larger and trying to monetize that journey to value-based care. They're definitely going to need better management than they have in place now. And so we want, the financial piece of it's, I wouldn't say it's easy, it's really attractive, but we want people to focus on, the right reason to do it is that you do have to be part of this consolidation wave. It's not really going to be possible to run these smaller practices. And that's not to say a group of physicians can't get together and create a 200 doctor practice and do very well with it. They can, absolutely. But again, we want to make sure folks are focused on the right types of thoughts heading into these. It's not just financial.
Thank you. So I think, as everyone knows, one of the partners that a practice can look to is a private equity firm. And Bob, could you just kind of give us a private equity for dummies overview, so that we're all on the same page when we're talking about PE firms and when they do transactions?
Sure. And again, I think it's important, as Kim to point out at the beginning, that private equity is the sexy, thing that all the docs want to talk about at their meetings, who's sold to what and how much money they got. But there still are, there are a lot of other different buyers, and for any practice looking at all of its options, they need to make sure that they explore all of them. But when it comes to the private equity transactions, and again, part of this is because of the private equity model that Matt went through a little bit earlier on the economics, with scraping the income to an MSO and all that model, which has worked in the world of private equity before it even came into healthcare, is I think a big driver for at least from what we've seen so far, the success of these models. But typically, private equity, as you can see from this slide here, private equity firms take, they raise money from investors, and they bring they invest that money into companies that they can grow, that are typically not publicly traded. The lifespan of a private equity platform company is typically 5 to 7 years if they're very successful in executing their growth strategy, which is what it's all about, to increase the earnings of it. If they're very successful from either an M&A perspective or an organic growth perspective, then it can be on the lower side. And we've even seen transactions, we participated in one last year that took 3 years, a little over 3 years, before they actually did the second bite, where they rolled the equity, again, some of the terms in the private equity deals. But typically 5 to 7 years is the lifespan. But as we explain to doctors all the time, doesn't really matter. I use the analogy of, refinancing your mortgage on your house. It doesn't really matter when you refinance your mortgage to, it's a different bank coming in and taking over the mortgage on your house, but it's really not that big of a deal to the physicians in the business that they're taking over after they do that second bite. And as Matt said earlier too, I think it's very important to realize, especially in the physician space, that there are certain things now, as healthcare becomes so much more complicated, and there's all these complex opportunities to try to bend the cost curve down. It's hard for a physician to run his practice and practice medicine. And so some of that expertise that's very valuable is, the private equity firms they specialize in bringing in that expertise to help make the practice run more efficiently and help it grow. There's the other thing I'll mention too is there's different sizes of private equity. You have the small ones that are usually involved in the early stages of the physician deals, the lower middle market ones, and then they go up to tiers. And typically the lower middle market one, private equity firm would then sell to a middle market that then sells, it's a transition up the stairs of the size of the private equity firms. And again, the key to, as we said earlier, when we're talking about the economic, what are the economic ramifications of inflation and interest rates? These private equity deals are very, very leveraged. I mean, that's the whole way they're able to return get great returns to their on the capital of their limited partner investors, is because they are leveraging these deals, borrowing quite a bit. Which again, with interest rates going up, that's that's got to have some kind of an impact.
Great, thank you. I think, Bob, you alluded to this before, but Matt, maybe you can just give us a very brief overview of other potential strategic partners for doctors and besides private equity, which we just discussed.
Sure. I mean, a good example of a strategic partner is Optum, or later stage private equity backed companies. There are new platforms like in cardiology where you're dealing primarily with the private equity folks. But as that matures, like it has in orthopedics or GI, these become larger and larger companies, and there may be a private equity player back there, but we essentially look at them like strategics. So that private equity group can really migrate into that strategic buyer. But if you think of Optum as like the classic, 500, 800 pound gorilla with 60,000 physicians, that's a pretty classic looking strategic. And hospitals and health systems. Look, I don't mean to be negative, but it's going to sound negative. I just don't. They have a lot of physicians employed, and that number is now starting to decrease. And I think it will continue to. It is the most expensive method of care delivery that we have. And I don't think that's going to fit well unless, like certain systems, maybe Sutter and Kaiser have found ways to lower cost in their holistic systems where they kind of own a market. But a lot of them are just out there trying to, raise their fee schedules on, fee for service initiatives. And they're not really, from our perspective, going to be a big player in this if and until they can, learn to go at risk or lower costs to the consumer. It's going to be more challenging for them.
So I think that, thank you. I think that kind of logically leads to the discussion of consolidation, because consolidation, I guess, breeds efficiency. So I'll ask Bob if you can tell me some trends that you're seeing in your current, business of who's consolidating and who's leading these consolidations.
Yeah, I think it's, I like to believe, because we are on the physician side of most of this. I like to believe it's the physicians leading it, right? But I think not to sound like the broken record, but I really think what's leading it is tomorrow and next year and 5 years from now, with the idea that the cost of care and the whole delivery of the care is going to need to change. To not bankrupt the country and just skyrocket even more out of control. So I think that is probably the biggest factor leading transactions and leading the types of transactions and all that. I mean, and then I would say the second one, at least over just sticking in the physician space, which is where I live, physicians are changing. They're not, and I've seen over my 30 years, that all the young ones, the young ones starting out when I was starting out, are now the senior docs, retiring or at least senior in their practices, and they're different than a lot of the Gen Xers and the younger generations of doctors coming out now. So I think that's changing it too, from a what's attractive and how to create something that's going to be able to deliver the best care at the lowest cost.
Okay, so unfortunately we are running out of time, but I do want to get Matt's opinion, because Matt, I know you have very sort of lofty goals for the delivery of healthcare in general. And I think this kind of relates to consolidation. We're seeing these corporate entities come in and participate in healthcare in some way. So I'd like to know your opinion of just that, in general, and how it's affecting what you do and what Bob does on a day-to-day basis.
I wouldn't say, as I look through these names, they all kind of jumped in wholeheartedly in different, different approaches, and clearly not all are successful. I mean, Amazon's out of the business now. They closed down their, health initiative, and I'm sure they have others in the works. But I think there are things these companies do very well. They really don't understand the actual delivery system well at all. And I think there's a certain kind of arrogance in which they've approached it. And that's not to say CVS can't, write prescriptions and have an urgent care clinic, or that Walmart can't create its own insurance product for its mass of workers that it, underpays on a daily basis. So I think that there's certain things they can do well. The actual delivery and consolidation, they have not been at the forefront of it. They will not be, in my opinion, unless they are able to bring in, expertise and change the approach. There are aspects of healthcare that they'll impact, but in terms of how it plays into what Bob and I are doing, neither one of us has sold a practice to Walmart or Google or Amazon. I don't see it in the future.
Okay, so thank you very much. Thanks, Matt, and thank you, Bob, for joining today. Thanks to everyone who participated. I do want to mention that we will have later this afternoon a live Q&A for anyone who wants to ask our panelists any questions. And also feel free to reach out to any one of us directly, and we'll be happy to answer any of your questions.
Thank you.
Thanks.